Welcome to the Deep Dive, where we cut through the noise to get you well-informed fast.
That's right.
Today, we're plunging into, well, the really dynamic and often pretty complex world of semiconductor manufacturing. I mean, how do these major players not just survive, but actually thrive with all the global shifts and economic cycles happening?
It's a constant challenge.
And what truly drives their performance in this absolutely crucial industry?
That's precisely what we're tackling today. Our deep dive is all about Texas Instruments' recent second quarter 2025 earnings.
Okay, TI's Q2.
Yep. We've pulled insights directly from their earnings call transcript and also the official press release.
Right.
Our mission really is to cut through the numbers, the executive commentary, and just understand what's truly happening within TI.
See how they're performing.
Exactly, across their key markets and, what their outlook might suggest for the broader tech landscape that, let's face it, affects all of us.
Okay, so we've got the detailed earnings call transcript. That's great because you get the executive remarks and the analyst Q&A, that back and forth.
That's where you often find the gold.
Totally. And the official press release for the top line numbers.
Got it covered.
All right, let's get right into it then. Starting with a snapshot of Q2 2025. What did it look like?
Indeed. So the headline for Q2 was revenue coming in at $4.45 billion,
Okay.
which was a solid 9% increase sequentially, quarter over quarter,
Nice jump.
and a notable 16% jump year over year, largely meeting the company's own expectations.
And what about profitability? Because revenue is one thing, but
Right. How much are they keeping? Well,
Right.
it looked remarkably robust. Gross profit hit $2.6 billion.
$2.6 billion.
Yeah, which is a very healthy 58% of revenue. Gross margin.
58%, okay.
And operating profit wasn't far behind. $1.6 billion or 35% of revenue.
And that's up from last year.
Impressively so, up 25% from a year ago. It really speaks to their operational efficiency, I think.
Definitely. And the bottom line, net income, EPS.
So net income for the quarter stood at $1.3 billion.
Okay.
Which translates to earnings per share of $1.41.
$1.41.
Got it. And actually, it's worth noting that this EPS figure, it included a little 2-cent benefit.
Oh, really?
Yeah, one that wasn't factored into their original guidance. So a slight beat there versus maybe what some expected internally.
Interesting. And looking deeper at the different divisions, how did they perform?
Yeah, good question. We saw growth pretty much across the board, which is always a good sign, right?
That is encouraging.
Analog revenue, which is, a huge part of TI's core business.
Massive for them.
It grew a strong 18% year over year.
50%, okay.
Embedded processing was up 10%.
Right.
And their other segment, which includes things like their DLP products, digital light processing.
Yeah, the projectors and things.
Exactly. That grew a respectable 14%. So overall, pretty solid performance to kick off the discussion.
Okay, solid numbers. But to really understand them, you need the context, right? The market dynamics.
Absolutely. And TI's leadership highlighted two really significant forces shaping the industry right now.
What are they?
Well, first, and maybe most fundamentally, is the semiconductor cycle itself.
Ah, yes. The cycle. Always the cycle.
Always the cycle. And the cyclical recovery, it seems, is definitely continuing. That's a signal we're observing across the entire industry, really, not just at TI.
Okay, so the tide is rising generally.
It appears so.
And what's particularly interesting, or what did they say was interesting, about this recovery's driving force?
Well, a key factor is that customer inventories remain at impressively low levels.
So low.
Okay.
So people burn through the excess from the pandemic boom.
Seems like it. So given that TI is specifically positioning itself, how are they doing that?
Right, how do they capitalize? What makes them maybe better positioned than others?
That's a great question they addressed. TI has been strategically investing in manufacturing capacity for years now.
Right, we hear a lot about their fab builds.
Exactly. And they're maintaining a healthy level of their own inventory. They believe this combination puts them in a well-positioned place, to use their term. Meaning they can capture demand as the recovery unfolds. They can respond quickly when customers need chips, without those super long lead times we saw a couple of years ago.
Gotcha. So it's a deliberate strategy. Be ready for the upturn.
Precisely. Be prepared.
Okay, so that's force number one, the cycle. What's number two?
Force number two, tariffs and geopolitics.
Ah, the other big cloud.
You could say that. Executives explicitly stated that these factors are, and I'm quoting here, disrupting and reshaping global supply chains.
Not just theory, then. It's actively impacting them day to day.
Very much so. And TI's strategy in response is essentially to leverage their global manufacturing capabilities for maximum flexibility.
So having fabs in different places helps.
They believe so. They're preparing to, quote, navigate as things evolve, recognizing how fluid the situation is.
This really raises such an important question, I think, for any global company these days.
Which is,
how do you balance that immediate market noise? Tariffs change, suddenly demand shifts, maybe overnight.
right, the short-term volatility.
Exactly. How do you balance that with these crucial long-term strategic investments?
Yeah.
Building fabs, R&D, stuff that takes years and billions of dollars.
It's a huge challenge.
So how does TI specifically navigate that kind of tricky balance?
It's certainly a delicate dance. They really view their globally distributed manufacturing, especially their growing U.S.-based footprint, as a key competitive advantage here.
A strategic asset.
Definitely. They believe having these diverse geographic options helps mitigate risks from trade tensions, but also provides stability for their customers who are also looking to de-risk their own supply chains.
So it helps TI, and it helps their customers feel more secure.
That's the idea. It's about being nimble enough for the short-term shifts while staying absolutely committed to that long-term capacity plan.
Okay, that makes a lot of sense. So given those broad dynamics, the cycle upswing, the geopolitical noise, let's now turn to the nitty-gritty. Performance across specific customer markets.
Right.
Because you mentioned it's a bit of a mixed picture, right? Some booming, others maybe more cautious.
Exactly. And this is where the story gets quite compelling, I think.
Okay, lay it on us. Who's hot?
Well, the industrial market, which is just a massive segment for TI.
Huge for them, yeah.
It was, and this is their phrase again, absolutely running very hot.
Running very hot. Okay. That's strong language for an earnings call.
It is. It increased in the upper teens year over year.
Wow.
And mid-teens sequentially, with recovery visible across pretty much all the subsectors within industrial.
So what's driving that? Just broad economic improvement or specific applications?
It sounds like it was largely broad-based, just a healthy resurgence across various industrial applications, factory automation, medical, grid infrastructure.
Okay.
And what's also notable is that other segments showed really impressive growth, too.
Like which ones?
Personal electronics revenue up around 25% year over year.
Okay, strong.
Enterprise systems surged by about 40% year over year.
40%. Mostly data centers, I assume.
Primarily, yes. We'll come back to that. And communications equipment saw an impressive jump of more than 50% year over year.
Over 50. Okay.
So, as the executive summarized it, that's 4 out of 5 markets recovering in a nice pace.
4 out of 5. But there's always an outlier, isn't there?
There usually is.
Which market was it this quarter?
This quarter, it was the automotive market.
Ah, interesting. Because auto has been so strong for semis for a while.
It has. But while it increased, mid-single digits year over year.
Okay, still up year over year.
It actually decreased low single digits sequentially, quarter on quarter.
Huh. That's definitely a contrarian move compared to industrial and enterprise. What's going on there?
Yeah, the CEO offered some valuable perspective on this. He explained that automotive peaked about a year later than industrial did.
Okay, there's a lag.
Right. Auto peaked Q3 2023, whereas industrial peaked way back in Q3 2022.
Got it.
So because of this inherent lag, its recovery is logically expected to be last.
And maybe not as sharp.
And, quote, shallower. Exactly. He stated it has not recovered yet and is currently hovering around a certain level of high single-digit down versus that peak number.
So still bumping along the bottom.
Pretty much. And the tone from the automotive customers themselves still sounds quite cautious.
How so?
They're making, quote, orders only when they really need it. There are no signs yet of inventory replenishment happening at the OEMs, the car makers, or their Tier 1 suppliers.
So they're still working through whatever inventory they have or just managing very tightly.
Seems like it. So if we connect this back to the bigger picture, the overall cycle, it suggests that because automotive was maybe a year delayed in its peak, its recovery could genuinely be sometime in the second half of the year.
Okay, so still patiently waiting for that one to really turn the corner. It hasn't quite joined the party yet.
Not quite yet. Still waiting for its invitation, maybe.
All right, so we have the operational picture, the market picture. Let's talk about the financial foundation, capital management, shareholder returns. How did TI look there?
Right. Always important. TI demonstrated strong cash generation in Q2. Cash flow from operations was $1.9 billion for the quarter.
Just in Q2. Yeah.
And an impressive $6.4 billion on a trailing 12-month basis, so generating a lot of cash.
And what about free cash flow? That's a metric a lot of investors watch closely.
Absolutely. Their free cash flow, which, is a non-GAAP measure, but really useful.
Shows cash left after investments.
Exactly. It came in at $1.8 billion on a trailing 12-month basis. So still positive despite heavy investment. It's a strong indicator of their liquidity and their cash-generating capability.
And they are investing heavily, right?
Oh, yeah. Over the past 12 months, TI put $3.9 billion into R&D and SG&A sales, general and administrative costs.
Okay.
And another $4.9 billion into capital expenditures, mostly those new fabs.
Almost $5 billion in CapEx.
Wow. Huge sums. But despite these really substantial investments in their future,
they're still returning cash to shareholders.
A remarkable amount. They returned $6.7 billion to owner shareholders in the past 12 months.
$6.7 billion. How did that break down?
Well, in Q2 alone, it was $1.2 billion in dividends.
Okay, hefty dividend.
And $302 million in stock repurchases.
So buybacks too.
Yep. So significant returns.
And the balance sheet itself, still healthy.
Looks robust. They ended the quarter holding $5.4 billion in cash and short-term investments.
Okay, decent cushion.
They did issue $1.2 billion of new debt during the quarter, which brought their total debt up to $14.15 billion.
Right, funding some of that CapEx, presumably.
Likely. But their overall capital allocation philosophy, they stressed, remains consistent.
Which is?
They aim to return, quote, all free cash flow through dividends and buybacks over time.
All of it. Okay.
Yeah, though the specific mix obviously depends on factors like their CapEx needs at the time, current cash levels, and the stock price for buybacks.
Sure, makes sense. A clear shareholder-focused strategy, though.
Very clear.
Okay, so we reviewed the numbers, the markets, the finances. Now, you mentioned analysts on the call honed in on something a bit more subtle.
That's right. A perceived tone change from TI's management.
The tone change. Okay. First, what's the actual guidance for Q3?
Good point. For Q3 2025, TI is guiding revenue to be between $4.45 billion and $4.80 billion.
Okay, so the midpoint is slightly higher than Q2's actual.
Exactly. And earnings per share expected in the range of $1.36 to $1.60.
All right, so the numbers look okay, maybe slightly up sequentially. What exactly did the analyst hear that sparked this perception of a shift in tone, moving from, what was it, off to the races?
Right, that was the feeling maybe a quarter or two ago.
To now staying flexible. What's the nuance there?
Yeah, the CEO clarified this. He emphasized that while the underlying cyclical recovery is strong, Q2 definitely experienced some, his word was, noise from tariffs.
Noise from tariffs. How?
Specifically, he said, in early Q2, there was an acceleration of demand.
A sudden spike.
Yeah, which the company believes was likely due to customers pulling in orders, building inventory.
To protect themselves from tariffs, getting ahead of potential price increases or restrictions.
Precisely. But that phenomenon, that pull-in, it normalized later in the quarter.
Okay, so it wasn't sustained.
Right. And that sort of temporary bump in the normalization influenced the perhaps more cautious Q3 forecast compared to if that hadn't happened.
So it wasn't necessarily a slowdown in underlying demand, but more like a pull forward messing with the quarterly pattern.
That's the explanation. A pull forward due to geopolitical events.
And China played a significant role here too, right? That market's been volatile.
Absolutely. China revenue for TI was up about 19% sequentially.
19% quarter over quarter in China.
And a whopping 32% year over year.
Wow.
With industrial leading that growth in China. So this higher pull from China in Q2, likely tariff related as well.
Contributed to that hot industrial number overall.
Exactly. But it also played into the maybe more conservative Q3 forecast as that specific surge likely normalize.
Got it. So despite this noise, they still think the underlying recovery is solid.
Yes. They believe it's strong, even if it's being, quote, masked a little bit by this tariff environment.
Okay. What about margins? Gross margin for Q3?
Expected to be about flat sequentially compared to Q2.
Flat, even with higher depreciation hitting from all the new fabs coming online.
Right. Normally, higher revenue might lift margins, and depreciation would pull it down. Here, they're netting out to flat.
Why is that?
It seems to be due to a roughly $20 million unfavorable impact expected from other income expense and interest expense that's offsetting the operational leverage you might otherwise see.
Okay, so some below-the-line items keeping it flat.
Seems that way.
And just to confirm, no change to their massive CapEx and depreciation plans.
Correct. They reiterated a previous framework, still expecting to spend $5 billion on CapEx in 2025.
$5 billion.
And somewhere between $2 billion and $5 billion in 2026, quite a range there still.
And depreciation keeps ramping up with it.
Yeah. Expected to increase to $1.8 to $2.0 billion in 2025, and then $2.3 to $2.7 billion in 2026. That's a growing headwind for reported earnings, obviously.
Absolutely. Big numbers. Now, there was also some news on the tax front, right? U.S. legislation.
Yes, a significant development, actually. They sounded quite positive about the newly enacted U.S. federal tax law.
What's in it?
Key things for them include the ability to immediately expense U.S. R&D and CapEx again.
Well, that's huge for cash flow.
Huge. And also an increase in the investment tax credit, the ITC, specifically for semiconductor manufacturing, from 25% up to 35%.
Another big boost. Are these benefits in the Q3 guidance yet?
No. They explicitly said Q3 guidance does not include these changes yet. They're still evaluating the full impact.
Okay.
But what's truly impactful here, and they highlighted this, is the expectation of, quote, significantly lower cash tax rates for the next several years.
Significantly lower cash taxes.
Yeah.
Okay, even if the GAAP tax rate, the one they report on their income statement, might initially go up a bit in Q3.
That's right. They guided the GAAP rate up for Q3 before it likely decreases in 2026 and beyond. But the cash taxes paid should be much lower sooner.
Why is that distinction between cash tax and GAAP tax so strategically important for a company like TI, spending billions on fabs?
It's a crucial point. Lower cash taxes means TI gets to keep more of its actual operating cash right now internally,
Instead of sending it to the government.
Exactly. This provides just a powerful lever for continued direct investment in their critical R&D and especially that manufacturing capacity build-out.
So it fuels the strategy.
Directly. It gives them a potential long-term cost advantage over competitors who might face higher cash tax burdens or need to borrow more. It's direct fuel for their growth engine.
Okay, that makes perfect sense. And that brings us perfectly to these strategic differentiators. Their manufacturing capability is a massive part of the TI story.
Huge.
They talk about having geopolitically dependable capacity. What does that mean in practice?
Well, it refers to their global footprint, but particularly their expanding U.S. manufacturing base. LFAB in Utah, RFBs in Texas.
Right.
And they stress this is a strategy they've been developing over 5 years or more. It wasn't just a reaction to the recent tariff situation.
So foresight. They were building this resilience before it became today's hot topic.
That's the narrative, and it highlights TI's thinking ahead. Now, they do acknowledge that while a few, quote, savvy customers are already actively shifting and getting closer to U.S.-based manufacturing.
Looking for that dependable supply.
Exactly. But they also said there's still a lot of confusion at the broad customer base. The full opportunity here, as they put it, has not played out yet.
So the long-term investment gives them an advantage as companies increasingly prioritize supply chain security.
That's the belief. It positions them for a future where supply chain resilience and geographic diversity are really paramount, not just nice-to-haves.
And they seem confident they can deliver.
Very confident. TI firmly believes their opportunity in this space is, quote, greater than their challenge. Okay. They feel they offer the scale and the size of the required capacity that customers will need, and that it's also very affordable, low cost, very competitive.
So scale and cost competitiveness from a secure location. That's the pitch.
That's the strategic long game they're playing, preparing for this world that's increasingly demanding localized, resilient supply chains.
All right. And the other big strategic area, you mentioned enterprise and AI earlier.
Yes. Lastly, let's talk about the enterprise market. As you guessed, it's primarily driven by data centers for TI.
And AI is driving data center growth like crazy.
Undeniably. And here's where it gets particularly exciting for TI's story right now. Their data center business is performing, quote, very well.
How well?
Growing very nicely at a very high level, specifically above that 50% year-over-year mark we mentioned earlier for the overall enterprise segment.
Above 50% year over year just in data centers. That's huge growth.
It really is.
So how is TI uniquely positioned here? I mean, lots of companies sell into data centers. Are they doing something specific related to AI?
Well, they are benefiting from the general build-out, obviously, but they see the future opportunity as moving beyond just general power components.
Okay.
It's about expanding their positions into more application-specific opportunities.
Tailored chips.
Kind of. Based on new technology that's ramping up in their Sherman, Texas facility, they mentioned samples are already out with customers.
Oh, new products specifically for this boom.
That's the idea. And this represents a, quote, potential tailwind in 2026 and beyond. So, while they're already benefiting strongly now,
They're developing the next generation of solutions specifically for these evolving, maybe AI-driven applications.
that seems to be the plan. Investing now for future share gains.
Okay, fascinating.
Yeah.
So wrapping this all up then, we've covered the quarter, the markets, the finances, the strategy. What does this all mean for you, our listener?
Well, I think it shows that while the immediate future for Texas Instruments has this kind of mixed picture, right? You've got the cyclical recovery continuing.
Which is good.
But also this ongoing geopolitical noise, the tariffs, the cautiousness in automotive.
Creating some uncertainty.
Exactly. But through it all, their long-term strategic investments, particularly in manufacturing and technology, seem to position them really uniquely for resilience and ultimately future growth.
Yeah, it feels like a company playing the long game very deliberately.
Absolutely. It's really a testament, I think, to the idea that foresight and just consistent, deep investment, even years before specific market shifts or geopolitical events, become totally obvious that can truly differentiate a company.
That decades-long commitment to building capacity, building R&D, it's now really playing out as a significant competitive advantage in today's world.
It really seems to be.
Indeed, it leaves you thinking, doesn't it?
How so?
Well, consider how a company's deep, long-term commitment to things like manufacturing and R&D, sometimes even decades before specific geopolitical events completely reshape the world. How that commitment can not only shape its resilience, but potentially unlock completely unexpected opportunities for growth and market leadership in this rapidly changing global landscape we're all navigating.
A powerful thought. Strategy meeting circumstance.